With inflation at a near 40-year high, the stock market down 23% since January, the housing market cooling off, the crypto market down $1 trillion, and a hurricane brewing in the South, it's needless to say that 2022 has been, well, absolutely insane. But in this video, we need to talk about urgent news from the Fed, about how 2022 is going and the potential recession that, let's face it, we're kind of in right now, and what 2023 is going to bring, and what we, as smart investors, should be doing to prepare. We're going to talk about the fact that if you would have invested in a very particular matter back in the last time that the Fed was increasing interest rates, how much your portfolio would be up today, even despite the fact that it's down 23%. But let me direct your attention to this article first, and it kind of lays the groundwork for the BS that we're going to be under in this next week ahead. So here we are on Yahoo Finance. You can see the Fed-induced sell-off may not be over. And what to know this week. Now, what's interesting is it says right here in the very first line that the S&P 500 could retest its June low this week ahead of equity markets and during a brutal bout of selling spurred by the fears of the Federal Reserve's inflation fight, and that may cause a recession. Now, first of all, let's back up a second, and the fact is a recession is identified as negative decline in the GDP, that stands for gross domestic product, over at least 2 quarters or more. Now, what's interesting is we were trending that way. Quarter 1 and quarter 2 were starting to go down. We have seen a little bit of an uptick in the GDP. But if you look here down a little bit further into the article, recessionary worries also extend beyond equities. The rate-sensitive 2-year Treasury note spiked above a fresh 15-year high of 4.2% on Friday. 10-year Treasury note, 3.7%, highest since 2011. So, I look at 2021, last year, we were feeling good. Portfolios were going up, everybody was buying in, everybody was feeling very strong. There's a problem with that. And we need to first talk about that problem with this right over here, and that is the overall monetary supply. Now, the reason I have this graph so zoomed out is because of the importance of the graph. Check it out for a second. Here you have the course all the way back into the 60s, and look what happens right at the end of 2020. We have this upward spike that goes absolutely mad all the way up, and look how high it is. Now, if you look at how we were trending over these years, sure, we were increasing our monetary supply, but look at this sudden spike. So all of a sudden we have stimulus checks coming out, we have business loans going out, we have grants, we have all this stuff coming out. The monetary supply goes up significantly, and now that has endured in a lot of pain. That is one of the pieces of why inflation is the way it is. Now, Jerome Powell, the Fed chairman, has specifically said that they are going to focus on this, and we're going to have to endure a lot of pain. We'll hop to this chart right here that shows us the federal funds rate. Now, look at this for a second. You see that in 2022, we start going up significantly. Now, if I scroll back to the last 25 years, and let's get even better than that, let's go to the maximum. You can see this obviously is a sudden tick if you look at the last couple of years, in fact, the last 10 years plus. But look back here in the 80s, we're going all the way up to a 20%. Now, that's important to think about, because if we keep saying that inflation is at a 40-year high, here's the big warning, here's the big truth that we need to buckle up and put our lap bar down for, because this roller coaster ride is about to get absolutely nuts. If we need to control inflation, what do you think they have to do? If you got monetary supply up as high as it is, which we just looked at right here, and then you have inflation at a 40-year high, and they're trying to bring it down to the nice tame 2% that they like to see, well, how do you get to that point? Is it going to be enough to be around this 3%? Are we going to have to go back here in 2000, or just like we were back in these days in 1980, go back up to an absolutely insane level of federal fund rate? Which means the prime rate changes, which means your credit cards change, which means the mortgage rates changes. I mean, mortgage rates are now going for about 6%. Compare that to about a year ago at 2.5%. All of this stuff is going to create a couple things. This ricochet effect is going to create unemployment. It's going to create issues such as higher interest rates. It's going to create potential squeezes in people's budgets. Therefore, they're not going to spend as much. What does that trigger? A recession. And that is something that we just need to stop filtering what we're talking about. Now, I'm not a financial advisor. I just see what I see. I see a lot of opportunity right now, but I see a lot of things to be very cautious about. The fact that this is not yet over. Until inflation gets back to that target of 2 to 3%, I think that the Fed is going to continue month after month to be more aggressive, because at the end of the day, they don't care about politics. They don't care about what's happening. They don't even really care about you and I. They care about their target goal. 2 to 3% inflation. And I've been waiting for a little bit to share this, and we're going to share it now. Here's the inflation rate as we are looking at it at 8.3% as of August. The next time that we're going to see this is on October 13th. So brace yourself, October 13th, if this comes out and it's still in the 8%, the stock market's going to react. The crypto market's going to react even more than it is today. If it is even, I would say if it drops to 6, we might see a little bit of improvement. If it drops to 3%, oh, we're back in the clear and everything's rocking and rolling. And then it's time to get really excited about the stock and crypto market once again, because we're going to see some green. But I highly doubt that happens anytime soon with the federal fund rate being so low. So my whole thought here is if we look at the overall span, now this goes back to before 1940, which we don't have the federal fund rates in that particular chart that we looked at. But let's zoom in here to 1980 for a second. If we scroll up here, we can see right there we are at 15%. Okay, so 15%, and this 8.3, I'm going to round up to 10%. So there's a 5% difference in inflation. Back in the 80s, we're surging high at 15%. Now at 10%. But let's look at the federal fund rate. So if you look at the federal fund rate in 1980, you're at 20%. So you're combating that. So even if, you could say that this really helped kind of pull us back from the inflation rate, because you can see from 1980, they start kind of messing around with this. And then here comes inflation coming back down right over here. See how the inflation rate goes back down? That's where they want to be. In fact, they got to their target right around here. I think that's probably right in like late 80s, early 90s right there. And how did they do that? By aggressively rising up the interest rates and doing another boost back in 1990. So the question would have to be, of course, we were in this 1980s recession. What's going to happen to get this under control? Let's say it's a 5% differential. Okay, so if you're going to just compare apples to apples for a second, here we go at the 15% versus the 10%. So let's take off 5%. We would have to raise the interest rate up less than 5 to a 15% interest rate to control this historically high inflation. They keep saying 40 years, and that's why I'm using these graphs. Let's be realistic. Let's look on the past to predict the future. Why is nobody talking about this? we're going to continue to be more aggressive. Maybe we'll get up to 5 or 10%. Things are a little bit different than they were in 1980. Monetary policy is a little bit different, but how are you going to control this if it keeps running off the rail? That will then push us to what we're talking about, which is the stock market continuing to go down. Now, look, I have continued to invest all throughout 2022. And I think it's really important to note that where I am now and where I'm going to say that you should put your focus on in 2022 to get to a more successful point, even if 2023 ends up being worse than 2022. Let's say we have to endure a recession over 2023 and we keep having the stock market and the crypto market recede down. What's going to happen is you're going to feel like you're just throwing your money into a toilet. And that's what I'm feeling like. In fact, you'll remember on this channel right here, at the beginning of the year, I decided I'm going to put $5 a day into the S&P 500 and another $5 per day into Ethereum for cryptocurrency. Both of those things are down right now. I set it up automatically within my Robinhood app, and that's what I'm doing. I just do $5 a day, every single day, and it's down. So every day I invest $5, I'm kind of flushing it down the toilet. Even though I feel like I'm putting my $5 a day into the S&P 500 and Ethereum and it's evaporating, remember that I'm buying shares. And when those shares go back up, when the price goes back up on both of those type of investments, my portfolio will rise with it. So what happens if you look at, I'm going to zoom in here to our chart again. Let's go back to the last 10 years. Look what was happening in 2018. This was going up, right? We had the federal fund rates going up in 2018. Let's take a look at the S&P 500. If we come back here, let's do 5 years. See what's happening here in 2018? If we go, let's say, the beginning of 2018 all the way through to the end, which is right about here, it went down 14%. So we're raising up interest rates, stock market's reacting, and it's going down. What happens if you would have ignored the noise? And you said, I don't really care about the fact that it's going down. I know that they're raising up interest rates. I'm going to continue to invest. I'm going to invest $5 a day into the S&P 500. So here we are, December 2017, and we're going to go until January of 2019. So that kind of covers all of our basis of 2018 as we're rising up the interest rates. The initial amount's going to be $5, and what we're going to do is we're going to cash flow a fixed amount of $155 every single month, and my idea behind that is that equals roughly about $5 a day. We're going to use VOO as our target, which is the S&P 500 fund provided by Vanguard, and I'm going to do a quick analysis on this. At the end of the year, your balance would have left you at $2,215. That's a sad return of only 3.74%. Now, the good news is it did actually go up, but because you're buying every single day, you're buying the highs and the lows as the stock market reacts. So now let's say what you're gonna do is you're gonna do things a little bit differently. You're gonna continue to carry on. Your $2,200, you're just gonna keep carrying it on. You're not worried about the noise at all, what's happening. And today, here's how much you would have. Your $5 invested every single day now brought you up to $15,075. That's a return of about 12%. So you have 12% return on your money. Now, there's going to be times, just like there are right now, where the market's going down. And look at this right here. Here we are in January. Look at all the pandemic-related issues. You had $7,300 down to $6,100. You lost $1,000. Now, you could have panic sold in March of 2020 because you're like, oh my gosh, the pandemic. But because you didn't and you just continued to just like not listen to the noise, look at this just rising up and rising up and rising up. And even though you're at $15,000, if you look back here in December of 2021, you had $16,000. This is the whole point of investing. You got to get to a point where you feel comfortable enough to stay consistent with everything going on. Ignore the noise, stay focused on your vision, and move forward. This leads us to the 3 points I would focus on in 2022 as the Fed increases their interest rates and the urgent truth about the recession. We got to be honest, the data that we just looked at, when it comes down to the Fed raising up the interest rates to combat the inflation, if you compare 1980 to today, how the heck is this going to happen? How are we going to get back to 2% without a proper set of action? You can't just toy around with these little percentage points, right? You're going to have to increase that a lot more, causing more fear in the market. So here's the things that you should focus on. Number 1, focus on getting out of debt, because debt is what's going to continue to cost you even more money. Let's say you have a balance on your credit card, you have a variable rate mortgage or anything like that. What's going to end up happening? Those rates are going to go up. It's going to cost you more money to hold debt on any of those type of vehicles. So it's important to pay down your credit card debt or consider refinancing and locking your mortgage rate in before it goes up even more. By having no debt, you have no liability. You don't have to care about the percentage points going up. I used to laugh about the fact that people would say, no, you're doing it all wrong. You got to invest, not pay off debt. Keep debt and invest. I'm so glad I didn't listen to that advice, and I'll tell you why. Because right now I'm completely debt-free, house and everything. And if I would have taken the time to invest instead, look at where we are today. Today would have just felt a little bit depressing, while at the same time I'm now having to pay debt on a higher interest rate. Now I don't have to worry about that. My interest rate and my debt is absolutely gone, zero, smush, goodbye, right? Now I can take all this extra money I have and invest while the market's down. And I can stay consistent, flush out the noise, and then focus on the growth in the future. Let's move on to number 2. The second thing that I would focus on if you're in the market to buy a house. Let's say you have to move, you have to get a house. Make sure you focus on getting a house that you're gonna live in for at least 7 years. Because if you're looking for a very short-term type of housing agreement, the mortgage rates are kind of high. You'll be throwing a lot of money out the window and you're gonna be moving soon. So it might be better to look into renting versus buying in that kind of case. Also, make sure if you are gonna have a house that you're gonna live in for 7 years or more, that you shop around for the best mortgage rates so you don't fall victim to a high unnecessary mortgage. And number 3, find more ways to make money. Now's the time to really boost up your opportunity to make more money, to increase your savings rate, pay off that debt, and then get to a point where you can invest a ton of money on this incredible discount sale. But you might be asking yourself, but what kind of great ways could I make money outside of my full-time job? Well, that's where this video will answer that question. I'll see you over there on that video next.